Welcome to our quarterly conference call for ROI Financial Group. So grateful that you joined the call. Friendly reminder to everybody on this call that you will remain muted until the end. So this call is being recorded and will be placed on our website that you can view anytime. So we're proud to deliver this information to you on a regular basis so that you can have insight to what our team and I are thinking about the markets. We're always changing, we're always evolving in the marketplace, and we want to make sure that you guys always have insight and accessibility into what we're thinking as we're managing your money. So feel free to share this video. Once we place on the website, feel free to share it with friends, family members, or loved ones because there's a lot going on. There's a lot going on in the world. The geopolitics of the world seem to change every day. And as you look at your accounts online and as you look at your statements, it seems that your accounts may very well fluctuate on a daily basis. They are going to fluctuate. So in today's call, we're going to walk through some overwhelming themes or overarching themes that we've seen in the markets throughout the year. And what we want to do is look at, even though the past is never indicative of the future, I'm going to take some time to look at where we were coming into the year, some of the insights and predictions that we made and see how those have kind of played out throughout the year. And two, where we are so that so we can get a feel for where we may be going. So all the ideas, the insights, the opinions that I walk through in this call are mine and mine alone. So some may be extraordinary, some not so great, but please note that these opinions are mine and mine alone, and they do not reflect the opinions of LPL or KPP or any of our affiliates. And always, 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 before you make any investment decisions, make sure you reach out to us or a financial professional to make sure you know and understand how your investment decisions impact you individually. So with that said, we've got a lot to cover. I'm going to go right into the presentation. And a friendly reminder about this presentation, for those of you that are clients, this Guide to the Markets presentation has JP Morgan created this more than a decade ago, and it's one that we lean on literally on a daily basis. So as financial advisors, as a fiduciary, it's not our job to dictate politics in Washington or dictate policy, nor is it even our job to debate politics or policy. It's our job to navigate through the geopolitical and the economic environments in which we find ourselves, regardless of who's in office, regardless of what's going on. Our clients entrust us to be able to navigate what's going on with as much, I would say, intellectual acuity and understanding what's going on, but also with an apolitical view so that we don't get too emotional one way or the other. So please note that during this presentation, of course, the economic situation we find ourselves, the geopolitics, both domestically and internationally, are going to affect the markets, but we don't take any political views. It's just our job to understand what's going on and be able to make sound and decisive decisions on your behalf, on our client's behalf, so that we can make sure that your investments are aligned with the risk profile that's right to you and also your goals. We always want to keep your investments aligned with your goals and your risk profile so that we can create as enjoyable an investment experience for you as possible, but also one that accomplishes your long-term goals. So we'll begin by looking at a quick overview of the market. This is a slide that I often begin with just to see where the S&P 500 is relative to where it's been in the past. And as we can see right now, the markets are actually trading very near all-time highs. Here's where we were in April prior to the declaration of Trump's tariffs. Here's the 20% decline that we experienced there. And as of now, we're trading near all-time highs. The markets are down a little bit today. We're going to walk through that. But the themes that we're going to walk through in this call are the AI marketplace or the AI industry, how that has disproportionately impacted the markets, what we expect or what we're looking forward to, and how we're managing the AI revolution and the AI industry and how we're participating that in our portfolios. But also when we peel back the layers of the economy, when we look beyond AI, we want to take a deep dive into how the foundations of the US economy look, how the international environment and how the international investments are beginning to look more and more attractive given some of the geopolitical events that we've seen in the near term. And also breaking it down to the US consumer. We're going to talk about the importance of the strength and confidence of the US consumer as we look forward and we navigate these markets that, again, are trading at all-time highs. Now, at first, when we think about markets that are at all-time highs, you may think that it's a time to become more cautious. And historically, that's actually correct. You're going to hear me throughout this call talk about how we're managing the valuations of the market, how we're looking for opportunities outside of the technology space, and how the general economy and how most companies may be able to benefit from this AI revolution, because you're going to see very soon that technology companies have disproportionately benefited from this the AI revolution and therefore this market run up. And there's a lot of caution that we want to be able to instill in our clientele, in our investors, because if we watch financial news and if you start reading, the word bubble is coming up again and again. Now, are we in the midst of a bubble? Unfortunately, you don't really know until after it happened. It's kind of like a recession. But what we're going to do is we're going to talk today about the underlying strength of the market, whether or not we feel there's a bubble. And again, we're not market timers. We're not trying to time the market, but what we want to do is maintain a well-diversified, disciplined portfolio so that if we are in a bubble in the technology sector, that we're able to participate in any potential growth until that bubble pops, but also be protected from a significant downturn in the event that occurs. So this chart here that I have on the screen shows what's called the PE ratio, the forward PE ratio of the S&P 500 from a historical standpoint. The bottom line is that this dotted line here, this 30-year average, represents the average price point of the S&P 500. If this gray line is above this dotted line here, the 30-year average, that means historically the S&P 500 is relatively expensive. Or another way to think about it is that investors are willing to pay a premium for stocks relative to the amount of money that those companies are making. So if we look back in 2000 or prior to 2000, we can see the price to earnings ratio of companies in the S&P 500 were very high. Why is this? Is because investors were purchasing technology companies, pets.com, and websites that weren't making any money because they thought that those companies were going to make a lot of money. Well, when we saw these companies not making money, the S&P 500 declined, and that's where we see the PE ratios fall back to historic norms. But it's important to note that low PE ratios, relatively or historically inexpensive markets, aren't necessarily a precursor to a bull or a bear market. Because as we can see, historically speaking, prior to the 2008 financial collapse, the price to earnings ratios of the markets were relatively low from a historical standpoint. So it's important not to put too much weight on this metric, but it is also important to notice that where we see valuations today, there have only been 2 times in the last 30 years where ratios were this high. And the first time was before the dot-com bubble. The second was after COVID-19, where stimulus checks were running through the economy and people were spending or investing money that they hadn't earned. And today, in the midst of the AI boom, there's a tremendous amount of exuberance and elation around the AI boom. So it's important to understand, one, how does the market react, or what happens to the S&P 500 historically when we see it priced as high as it is right now. And that's what this scatter plot does. So what JP Morgan did in this scatter plot is they looked back to 1993 and they looked at where the markets were on each month and put a point on this scatter plot and then determine what did the S&P do in the following 12 months. And we can see down at the bottom here where we can see when the equity markets are priced more favorably or less expensively, or when the PE ratios are lower, on average, the markets do relatively well in the following 12 months. When, however, we see PE ratios where they are today, in the following year, the markets don't perform as well on average. Why it's important to note on average is because we can see there are a lot of periods where the markets didn't do well, actually really grossly underperformed in the following 12 months, but also 12-month periods where the markets did well. So again, this isn't a necessarily predictive metric for where the markets are going to be, but what it requires us to be is a little bit more cautious, a little bit more leery of where we are so that we can start making a bit more strategic or tactical decisions, keep potentially a little bit more assets and more conservative asset classes so that we can capitalize on a downturn if there are opportunities to do so. And because then again, when we kind of pull out the range, this chart on the right shows what the S&P 500 does in the subsequent 5 years after a market downturn, or I'm sorry, in the 5 years after PE ratios are priced where they are today, we can see the subsequent 5 years, the markets are relatively tepid on average. So again, high valuations don't necessarily mean that we're in the midst of a bear market, but it's important to understand. So as we peel back the layers of the onions, one of the themes that we saw coming into this year that we were talking about was a broadening of economic prosperity. And quite frankly, that theme is going to continue to play out in our opinion. So what this chart shows is when we look at the price to earnings ratio of the top 10 companies, the green line represents the price to earnings ratio of the top 10 companies in the S&P 500. These are companies like Google, Amazon, Netflix, JP Morgan, Broadcom, the largest and mostly technology companies, Meta or Facebook is here. When we look at the PE ratio of these largest companies, we can see they're trading at a multiple over 30. But if we take out the top 10 companies of the S&P 500 and just look at the remaining 490 companies in the S&P 500, we can see that they're trading at a multiple of about 19.3, significantly lower than the technology companies. So again, one of the themes that we're looking at here is making sure that we understand the general makeup of the S&P right now, because not only are the top 10 companies disproportionately overweighted in the S&P 500, so the market cap of those top 10 companies represent over 40% of the S&P 500. So not only are the largest companies disproportionately outweighing the S&P 500, but they're disproportionately expensive as well. So if we go back to the slide where we can see historical price points of the S&P 500, the majority of stocks are trading below this first line of standard deviation, which is still expensive, but not as expensive as how much these top 10, the largest companies, are pulling up the valuation. So what that means is that we have to be selective and that we want to make sure that we're capitalizing on the growth that the largest companies continue to realize, but we also want to be cautious because April, when the president announced his tariff policy, we saw that the markets fell significantly at that point. Overall, the S&P in April declined a total of 19%. But if we look proportionately at what we call the Magnificent Seven, we're going to go dig in a little bit deeper from the 10 largest companies to the Magnificent Seven, which are the largest seven technology companies: Apple, Amazon, Google, Meta is Facebook, Microsoft, Nvidia, and Tesla. If we look at these technology companies, again, because AI has been dominating the markets, it's been dominating the news, it's been dominating the economy, quite frankly, and the way that companies, not just domestically, but internationally, are doing business. It has changed the structure of how we communicate, how we work, and it's only the beginning of this revolution. But when we look in April, when the markets fell, again, the S&P overall was down 19%, but the Mag 7 companies lost about 30% on average, a 30% decline from the Mag 7 companies. And when we look at the S&P X the Mag 7, if we look at the other 493 companies, they were down about 15%, 15% total. So this broadening theme has actually played out. We want to make sure that we're able to invest in where the puck is going, what we believe the future will bring. However, we have to be very, very careful because at some point, those companies are not going to be the top performers. I don't know when that is. I don't know how long it will be. But at some point, there are going to be other companies, other industries that come in. There's going to be a cycle shift in the economy, and there's going to be a cycle shift in the asset classes that are going to be best to invest in going forward. And what it's important to do is maintain a diversified portfolio aligned with your risk profile to ensure that we can do that. So when we look here, I'm going to go back one more time to the PE ratio chart because it's important to understand that there are two ways that the markets can become less expensive. The first way is that if stock prices come down, if we see the markets fall, then the price to earnings ratio will become lower. So if stocks fall, then we'll see the markets become, quote, less expensive. The other way that a stock can become less expensive is if the profitability of the company stabilizes and the share price, I'm sorry, if the profitability rather of the company catches up to the share price. So investors are buying companies like Nvidia, Meta, Google, Amazon, all these relatively technology companies at a market premium with the expectation that their profitabilities will grow and justify the price they're paying. People that were able to foresee the value of Tesla and invest in electric vehicles back in 2012 or 13 when it became public, Tesla lost money for almost a decade before it drew a profit, but people still bought that stock because they believed that electric vehicles were going to be profitable, and that's why they were able to wait it through. Tesla is not trading at a multiple of several hundred right now. It's trading at a relatively reasonable multiple, historically speaking. So when we look at the investments that companies have made into AI, what this chart shows is this shows US industrial production of high-tech industries. So when we look at this, effectively companies are just putting extraordinary resources into semiconductors, into communications equipment, into computer equipment. So companies are buying into the AI revolution, which is obviously going to be driving up these technology companies. But the questions that are starting to be asked is, well, one, how much money do companies have to invest in technology? It's not an infinite amount. It will start to stabilize. We're not going to see this chart to continue to go up. At best, we hope to see it start to stabilize a bit. And also, the investment that non-technology companies are making into AI eventually are going to increase productivity. Those investments, companies are making those investments because they want to increase and improve their margins. They want to make more money. So the hope is that we see a front load of where companies are investing their money. Those investments are going to stabilize at some point. So therefore, the profitability of these technology companies will start to stabilize. But we hope to see the profitability of other companies improve as well with that return on their investment into technology. So this is consistent with our broadening theme, and we saw that. We've seen that broadening theme, the remaining portion of the S&P 500, the remaining companies, non-AI based companies are going to ultimately, we hope, benefit from their investments, and over time we expect that to play out. And we want that to occur in a relatively slow, methodical, and meaningful way, because when you start to see spikes in the market that are too hot, well, those are indications of a bubble, and those are the things that we're watching out for. So overall, do we think that technology companies in certain sectors are overvalued? Yes. And what we're starting to do is we're going to see some profit taking in those sectors, rebalancing the portfolio back into a more normal allocation, and being able to increase fixed income exposure with short-term bond funds and high-quality bond funds, so that if we do see a bit of a correction, we want to make sure that we're able to capitalize on that, not lose as much as a general market correction, and be able to buy into the market like we did in April. And when that happens, folks, we are expecting at some point in the next 6 to 18 months a 5 to 15% pullback in the market. So when you see that happen, do not fret. We have seen extraordinary returns. In 23 and 24, the market, the S&P was up 24 and 23% respectively. Year to date, we're up over 11% in the S&P 500. But in April, you can see here what this chart shows is in April, we were actually down 19% from the February peak to the April trough. And every year going back to 1980, the S&P 500 has seen a decline that ended up being deeper than what the markets ended up at the end of the year. Again, the past is not indicative of the future. Could the worst day of the market be 12/31? Of course. But what this chart shows, and why I show it in almost every call, is because volatility is normal. Market movements are normal. The headlines that create that volatility are always different. So let's go into some of the headlines that we see today. Labor demand. Immigration has been in the administration's one of the key administration policies this year. So what has that done to the labor force? So when we look at JOLTS, this JOLTS job openings report, what this shows is we can see that job openings means, are employers hiring? Are there job opportunities out there? And we go back to 1973, and we can see there are certain it's cyclical. We saw enormous job openings right after COVID-19. So here's pre-COVID. During COVID-19, we'd expect job openings to fall because, quite frankly, companies were closing. When stimulus occurred, job openings skyrocketed because people weren't working at the time and Americans were given money they didn't earn, and there was a tremendous amount of demand. When stimulus stopped, we've seen JOLTS come back. So to see JOLTS, to see job openings back to where they were pre-COVID, means we're at a relatively healthy position, a market neutral position where we're seeing employers want to hire again. Also, we can see quits. Quits are down, where we can see people are stable. The US consumer, the US worker is confident in their job, where they're seeing stability. They're not wanting to quit. And the same with layoffs. Layoffs are relatively low going back the last 25 years. So the stability in the job market is very important, because the strength and health of the US consumer is the foundation of the US economy. When the US consumer is healthy and confident, the US consumer will spend money. And you'll see the importance of that not just domestically, but also internationally. So the strength and confidence of the US consumer is something that not only politicians are looking at, but the Federal Reserve Chairman is looking at, economists are looking at, and investors are looking at as well. And the relative strength of the US consumer right now is very good, because job confidence is high. When we look at unemployment, this dark line, so these two lines, the dark line represents the unemployment rate, and the blue line represents wage growth. So we can see unemployment spiked here to 14% in April of 2020 during COVID-19. And when we look here, on average, employment rate is at about 6.1% historically. We're sitting at a current unemployment rate of 4.3%. That's almost a full we almost have full employment right now, which is extraordinary. Also, wage growth. As we've seen inflation start to come down, we've seen wage growth stabilize, which is actually relatively good because that's good for employers. In order for employers to be able to confidently employ and pay their workforce, the rising cost of labor is a detriment to the workforce. If employers can't afford to pay their employees, that's going to create a disruption in the consumer, and that's going to create a disruption in the economy. It could by increasing layoffs. So we're starting to see stability here, and we're looking here historically, going back the last 50 years, very rarely have we seen such low unemployment and relatively we're right at the historical average of wage growth, which is at 3.9%. Okay. So again, keeping with the theme of making sure the consumer is confident, low unemployment, good for the consumer. Stable wage growth, good for the consumer. If they know that they're going to get a pay raise that is aligned or at least keep up their quality of life, that gives them the confidence to go out and spend more money. So how do we know that their wage growth is keeping up with inflation? Because this chart shows where we are with the current inflationary rate. Year over year, we're looking at a 2.9% inflationary rate. The Federal Reserve target is about 2.6, so we're a little bit above the Federal Reserve target, which makes us believe we're probably going to see at least one more cut in interest rates before potentially the end of the year. But when we look at, we see inflation has come up a little in the last couple months, but the trend has been extremely optimistic since 2022. We've seen the cost of energy come down. We're starting to see the cost of shelter go down. Auto insurance was a very stubborn metric. We're starting to see that come down. So the bottom line is we're starting to see a stability. The American consumer is getting used to current inflationary rates. I don't believe that we're going to see inflationary rates the same as we were prior to COVID-19 and we experienced in a relatively low interest rate environment. Those days most likely are over. Could we see it again? Perhaps. But the reality of it is having an interest rate environment where we are right now, if we do go into a recession or in order to stave off depression, it's important that the Federal Reserve have some levers to pull, and we'll talk about that in a moment. So quite frankly, our analysis at ROI Financial Group is that inflation at this rate is relatively stable. The expectation is we're going to see the Federal Reserve probably pull another quarter point reduction in the midterm lending rate before long. But what we are cautious of is too much of a reduction in the interest rate environment, because if we see too much of a reduction in the interest rate environment, that could be stimulative from an inflationary standpoint. If Americans don't have interest rates on their grills, their boats, their cars, or whatever it is they buy, they're going to buy more stuff, which is just going to drive the cost of goods up even more. And inflation is the silent killer of the middle class. So we really want to be cognizant of that. A stable inflationary environment gives Americans more confidence in what they're able to buy, and they're going to buy more if they don't think those goods are going to go up. So that's important. When we look at labor supply, again, in lieu of the current administration's immigration policy, we can see here that there's been actually a significant reduction in the labor supply. So what's been interesting here is that this chart here shows the growth of foreign-born laborers versus native-born laborers in the US. All of 2024, we could see that pretty much there was no growth in domestic-born laborers. In 2025, we've seen that there's been we've seen a significant tick up in domestic laborers. And in August of 2025, there's actually a net reduction in foreign-born laborers. Now, the fear here is that this is going to put pressure on certain industries that have relied on foreign-born laborers. So we expect to see pricing pressures in agricultural spending, in commercial development, in housing, and things like that. So if the cost of labor goes up, then we expect to see prices go up in certain sectors there. But what this also does too is if we see the labor force, what's significant here is that current data is showing that even though we're seeing a net reduction in foreign-born laborers, domestic or native-born laborers are actually filling in that gap. So yes, we're seeing a reduction in the labor supply, but so far in the near term, it's been actually surprising to see how that labor supply has been filled by domestic-born workers, which time will tell to see the true implications of this. But I thought this was an interesting statistic to look at. Before I go on to the next slide, the summary that I want you to take away from the last several slides is that the data suggests that the American consumer is actually standing on very solid ground, and that the data suggests that we're seeing stable inflation, we're seeing a stable jobs reports. We see a relatively low supply of labor, so that there's going to be high demand for work based on the job openings report. So there are more job openings than there are laborers, which should give the American consumer confidence. But the American consumer generally doesn't do a very good job of predicting how the markets are. In other words, there's a lot of uncertainty in the market. So what this chart shows is actually consumer sentiment. So this gray line represents, going back to 1971, consumer confidence. How confident was the American consumer going out to the mall, Amazon, you name it, and going out to buy things? And right now we can see consumer confidence is actually near a historically low levels. But the irony behind this, and why I love this chart, is that, again, I don't think this is a causal relationship at all by any means, but it just so happens that historically, consumers, when they're least confident, in the following 12 months, the markets have done historically well. So when we look back, what JP Morgan has done is they've tracked what the S&P did in the following 12 months after consumer confidence hit these low points. In 1975, the markets returned 22% after consumer confidence hit a low point. 1980 to 81, markets were up 20%, 29%, 32, 14, 22. Most recently in 2022, markets returned 17%. So now as we see consumer confidence relatively low, why that is? Well, if you turn on the news, it's very difficult to be confident with anything. The geopolitics of the world are highly unsettling. When we look at the uncertainty in Washington and things like that, it's easy to see why the markets are relative, or why the consumer is relatively lacks confidence right now. But historically, again, we never know, but historically, when consumer confidence is this low, the markets do relatively well. So again, to maintain with the theme, we believe that, again, not because of consumer confidence, it's because the data suggests that the consumer is healthy, the foundations upon which the American consumer is standing is strong and stable. And if American consumerism is strong and stable, that's going to drive GDP, that is going to drive corporate earnings. And then when we look at the AI revolution, as I close out this idea of the general economy, we do expect at some point these AI companies, these technology companies, it's going to get to a point where the growth is going to start to fizzle. We will see them come back to earth, but the investments that the general economy are making into these technology firms, they should realize a return on their investment as well, which again feeds into that broadening theme, driven by a strong consumer. Here's why. What's fascinating about the American consumer and why it's so important that we focus on them is because the US consumer makes up 68.2% of the US GDP. 68.2% of US GDP is driven by what Americans buy. If there's one thing Americans are the best in the world at, it's buying stuff, and we buy a lot of it. But what's most fascinating about this, that's probably not a surprise to anybody, but what's most fascinating about this stat is that US consumption makes up about 30% of all global consumption, which is absolutely extraordinary. So what that means is that foreign countries need us, foreign manufacturers, foreign workers need us buying things. We don't just need a strong and confident consumer. The world needs a strong and confident US consumer. So again, we're not playing politics. What we want to do is make sure we understand why and how tariffs are going to affect the general economy, the markets, and therefore how we're going to manage portfolios. So when we look at tariffs and how they've impacted the US economy, it's important to have a historical perspective. So right now, where we stand, tariffs make up are generally at about 17.4% on average. We have to go back to the early 40s, late 30s before we find a time when tariffs were this high. In April, when the markets fell by the 19% we saw, it's because the president was talking about 100+% tariffs with some of our key trading partners. It turns out that was a negotiation stance, and we've come down to a more palatable average rate for our trading partners. The same was true last Friday when the Trump administration came out saying that they were going to apply more tariffs to China. The markets responded negatively to that. Over the weekend, Trump put out a tweet saying that it was going to be okay. Markets rebounded yesterday. Today, we're coming back to earth. Now, what this is indicative of, and I want to talk about the last 3 trading days, is we do have some fragility in the market with what we've been talking about here. The consumer is strong, the US economy is strong, but because we've seen such a run and because we've seen based on just one tweet from the president, that volatility in the markets, there's underlying fragility, the underlying fear of a bubble. So investors are very, very cautious right now, and it doesn't take much for a bit of a sell-off. So we're cognizant of that, which also makes us want to shift over, just increase our defensive positions a little bit more on the models is something you're going to see over the coming weeks. But when we look at the tariff policy and what this has done with the federal finances, it's important to kind of gain some insight into why the Trump administration may be doing this. And then when we look at the federal finances, I want you to imagine if you had a child, a young 20-something-year-old child of yours that you just released out into the wild after paying for their college. And at 25, your child comes to you and says, Mom, Dad, here's what my balance sheet looks like. I've got $360,000 of credit card debt. I make $50,000 a year, and I put $70,000 a year on my credit card. Can you help me? If that were your child or your friend, your neighbor, your brother, your sister's balance sheet, you'd want to do something about it. And unfortunately, that's what the federal balance sheet looks like. We have about $37 trillion of debt. The government spends about $7 trillion a year and it only brings in about $5 trillion a year. And all that revenue that it brings in is all from taxes, from the income that Americans and corporations make. Very little, if any, of the revenue that the government has brought in has been because of tariffs. So tariffs are a means of leveraging the US consumer, leveraging the fact that we represent 30% of all goods and services purchased in the world. Again, we represent 30% of all consumerism. So the global economy needs to have access to the US markets. So tariffs are a way to bring in revenue to the federal government to supplement the taxes that the government receives and hopefully bring down the federal deficit. Nobody, if we continue to spend the way we do without driving the revenue to pay for our debts or to just pay for our basic services of the government, a government shutdown that like we're experiencing right now looks like a walk in the park compared to a default of the US government. So that's the nature behind tariffs. Again, not what we're not doing is taking a stance on it. What we're doing is trying to understand the nature of why these tariffs make sense, potentially from the federal government's balance sheet standpoint, and how the reaction initially to 100% tariffs, why the markets have responded relatively well, is because turns out that the world needs to have access to our markets. Companies are still working with American manufacturers. We saw that rise in domestic labor here. We see that rise, and that native-born Americans are able to find work. And in the short term, it seems to go well. But again, just based on what happened on Friday, one tweet represents fragility in the markets, which is why, given the overall valuation, given the fact that the markets are a bit overweight towards technology, you are going to see a little bit more defensive positions in the portfolio. So depending on the model that you're in, depending on your risk profile, if you're more in our more aggressive portfolios, you may start to see a shift toward maybe just a little bit more high yield bond, some alternatives that we're looking at, and things like that, so that if and when we do see a decline, we'll be able to redeploy some of those assets into the market, but also return a reasonable rate on those relatively safe assets in the meantime. Interest rates. Understanding interest rates are important because we expect to see another rate cut in the interest rate environment. But what's so important about interest rates is several things. First, for retirees, low interest rates make it very, very difficult for retirees to be able to realize an income or return on their savings. The closer you get to retirement, the more conservative you want to have your assets allocated because you want to preserve your portfolio. Losses hurt much more than gains can potentially help you when you're taking income from a portfolio. So if you are a retiree and you have a pension or you're leveraging income guarantees and annuities, what higher interest rates allow you to do is outpace inflation potentially, realize a real return on your portfolio, which is what this chart suggests. And if you want to incorporate guarantees through annuities or fixed instruments into your portfolio, higher interest rates allow you to protect your portfolio from equity declines and also from inflation. So when we look here, what this chart shows are nominal US Treasury yields. So when we look at current Treasury yields, if you put your assets into 10-year treasuries, you're looking at about 4.06% as of yesterday. And when we look at where inflation is, the inflationary rate at 3.11 means that if you invest in 10-year treasuries, you actually have a net positive return of about 0.94%. Even though in 22 and 23, we had these same current interest rate environments, with inflation as high as it was, there was actually a negative yield. So higher interest rates in a higher inflationary environment hurt the average investor, they hurt the average saver. So what we're looking at now are not only higher interest rates, but again, lower inflation. So very, very good, stable position, which if we have healthy and confident retirees, they're going to spend more money, therefore drive the economy. Getting back to the consumer. For retirees, you hear me say, when you're retired, every day is a Saturday. And when you're working, you spend a lot more money on Saturday than you do on Wednesday. So again, higher interest rates, they might be slow down the economy a little bit, but there's a balancing act that the Federal Reserve is playing. And we actually like where interest rates are. We expect them to come down a little bit, but there's that balance between lower interest rates and inflation. And it's a very, very thin, it's a very small tightrope and very thin ice. And when we look where yields are, what this chart shows is generally this shows the last 15 years. The gray represents the range of treasury yields over the last 15 years. This purple line shows the median in other words, about the middle point, and then this blue dot represents where yields are. So almost without exception, we see that current yields are higher than where they have been on average over the last 15 years, and we see them closer to their 15-year high point. So again, by moving over to fixed income instruments or getting back to a historically normal allocation, we're not necessarily giving up returns. We're looking at a positive inflation adjusted return with the way inflation and yields are. We're looking at historically higher yields, and with the market valuations where they are, having a portion of the portfolio in these defensive type positions, we believe makes some sense if we see a pullback given the fragility of the market. But it's important to know and remember that bonds are not a guarantee of returns. Just like we see volatility in equity markets, we will always see volatility in bond markets. For example, this year, the Bloomberg US bond market is up 7%, but from peak to trough, we've actually seen a 3% decline in the bond markets this year. 2022, when we went from near zero interest rates to where we currently are, bonds had a negative 13% return. What people fail to realize, it was actually the worst year the bond ag had ever experienced. And for people that believe that bonds are safe or bonds can't lose money, that's just materially false. So it's so important to be thinking tactically about your fixed income positions, to be able to understand the quality of the fixed income that you have, and understanding again how those positions fit in with your overall short and long-term goals. Okay. Lastly, international equity positions. Over the last 20 years, the US markets have absolutely dominated the global landscape. So it's been natural to be overweight US markets. But as of late, especially since the beginning of the year, we've seen a shift. And that international markets have actually, for US investors, have benefited from a weakening dollar. As a matter of fact, the dollar has weakened to the tune of 10 to 15% to the euro, for instance. So when we see the S&P 500 up 11% year to date, but the dollar has weakened about that same amount to the European consumer, that means if you're a European investing in the US market with euros, that asset actually didn't do well for you year to date so far. However, if you are an American investing in European markets that have actually done relatively well year to date, then you're not only able to benefit from the appreciation of European markets, but you're also able to benefit from the devaluation of the currency. This adds another layer of risk into the portfolio when you're looking at international investments. But if we look at the current environment, when we look at the current administration's trade policy, it's actually in the best interest of American corporations to have a lower value, a devalued dollar, because that makes American goods much more attractive to international investors. So a weakened dollar is stimulative potentially to the US economy, therefore to US equities, but also it makes European equities a bit more attractive. So what we've done in our portfolios is increased our international exposure to a more neutral weighting from a historical standpoint. So that means that's anywhere from 10 to 15% of the overall portfolio. And we believe that's a healthy neutral weighting, not only um, from a currency standpoint, but also from a valuation standpoint. So what this chart does to kind of bring the conversation full circle is that this shows, again, that the US markets are currently expensive. So this 22.2x, there's the current PE ratio, which is an allusion back to that second slide that we talked about. And historically, here's the range of the price to earnings ratio of the S&P. So we can see that the markets are relatively expensive in the US relative to the Japanese market. Japanese markets historically have traded at a 44x multiple. We're trading near historic lows, but also at midpoints, the 20-year average. When we look at the Eurozone, historically, it's again relatively not as expensive as we see European markets. Chinese market, quite frankly, I stay away from. The reason why the Chinese market at ROI Financial Group, we stay away from it is because the challenge with the Chinese market is that the reportings that they have are controlled by the Chinese government. And also, the Chinese government could at any time go into a Chinese corporation and incur a tax that could disrupt the profitability of that company. So even though we see the Chinese markets might be relatively expensive, the fact that it's government controlled and not free market controlled gives us pause to invest in that market at all. So the last thing that I want to show everybody is this slide as we kind of go into the questions for those who might be on the call. We are at all-time highs or close to it, right? We're close to it. We've seen a bit of a pullback in the last couple days, but we're close to all-time highs. So the question we get from clients is, well, we're at all-time highs. Why don't we just move to the sidelines for a little bit and wait for a pullback? And the reason is, it's fascinating. The reason is because market highs seem to beget more market highs. In other words, the markets are hitting all-time highs because the economy is strong. When the markets dip, it's because the markets and the economies are relatively weak. And what this chart shows is if you went back to 1950, JP Morgan went back to 1950, and they charted two types of investors. One, an investor that invested in every single day of the market, and another, an investor that only invested on days and where the markets hit an all-time high that set a new market floor. So in other words, you would think that, well, the person that invested every day, not just on days where the markets are high, but also on days when the markets are low, over time, that person must have outperformed the investor that only put in when the markets hit all-time highs. But ironically, if you look at the investor that invested just during the market highs, over every period from 6 months to up to a 5-year period, that investor that only put their money in on all-time highs outperformed that investor that dollar cost averaged every single day. So what does this mean? Again, yeah, the markets continue to hit all-time highs. Will there be a day where we see the markets fall? Absolutely. 100% that's going to happen, but it doesn't make sense to time when that's going to happen. The foundations of the economy seem to be very strong. But where we're looking for areas of caution are the sectors that we see the markets hitting. Again, technology, we believe that there is an extraordinary run. It would be naive to suggest that the technology that we're experiencing right now is not it's transformative to the entire world, and it's a market that we want to continue to invest, but it's important to continue to pull back and rebalance those allocations to make sure we look prudently at the entire portfolio and that we're not just focused on AI. So if we look at the returns, you may have friends say, goodness gracious, my portfolio is killing it, or you might only hear the wins that they're invested in Nvidia and things like that. Our clientele do have portions of their portfolio in these winners, but it's also important to keep your finger on the pulse because a long time ago I heard the analogy. The wrong time to put your life vest on is when a boat is sinking. The right time to put a life vest on is when the seas are calm and you're in a relatively stable environment. It's hard to put a life vest on when you're swimming in the water. So it's generally those times where we see, believe it or not, consumer confidence is relatively low. That actually creates a little optimism for us and our team because when consumer confidence is relatively low, that means Americans are relatively cautious. When we see interest rates peaking up a little bit, that's actually really good because if you can yield 5 to 7% in bonds, that's going to require corporate executives that are running companies. It's going to require them to run their companies with a bit more prudence, with a bit more patience, with more discipline. They're going to have to keep more cash on their balance sheet potentially so that they're going to need to be able to attract investors. If you can get 7% on a bond fund, why would you invest in a stock and hope to earn 8 when the volatility is enormous? So higher interest rates create stability. Relatively low inflation, sub 3% is relatively strong. Job openings are still strong, but the labor force is relatively low. That means there are more job openings than there are workers. That's a really good sign because that builds confidence and predictability with the consumer. We hope that they continue to spend money. So the long and short of it is this: the foundations on which we're standing seem to be very stable. There's a tremendous amount of uncertainty. When I watched our first guide to the markets, which is still on our website, I said coming into the year that we expected a tremendous amount of volatility as the new administration incorporates their agenda in Washington. We've seen that. We continue to see discord in the streets. We're seeing protests. We're seeing the things that we actually called in our first Guide to the Markets presentation in January. So we're actually seeing it play out. But if we continue to see this discord and we continue to see the uncertainty as we kind of have a stable footing, as the data suggests, then what we kind of see is a wall of worry. We see a prudent, stable, consistent overall market. Even as we might see a algorithmic gain, if we see a skyrocketing market in certain sectors, we want to be prudent, not necessarily want to participate in that, but we don't want to go all in there. So overall, the diversified portfolio, as we incorporate international exposure, as we get back to more standardized weightings in fixed income, we believe that when we do see some hiccups, as we have the last couple of days, that you, as our investors, should be more confident in that because we do have a plan and we really are expecting and anticipating this level of volatility. So, with that said, thank you for watching. If you have any questions or concerns and you want to reach out to us personally, feel free to give us a call. Phone number is 844 Kyle Roy. You can call us toll free 844-595-3769. We're going to send this video out. There's going to be a recording that you'll be able to find on our Facebook page. So if you have friends, family members, or loved ones that would feel that this information is valuable, please feel free to share that. And if you have any friends, family members, or loved ones that believe they're looking for predictability and calm and comfort with their financial plan, feel free to welcome or have them give us a call because there's no greater honor than you, our investors, putting your faith and trust in us with the people you care about most. So with that said, I'm going to close out of the call, and I want to thank you for joining. And on behalf of everybody at ROI Financial Group, thank you for joining. And for those that are on the call, I'm going to open up the call to any questions that you may have.